Do you expect this will be a small group of companies or a large group, or is it too soon to tell?
I think it's really too soon to tell. I think it is too soon to tell, yes. And we're learning more. Since we only regulate banks, and we now have some authority over bank holding companies as well, but the non-bank sector is something we're learning about, so I think there will be a learning process for members of the FSOC as well in making that determination.
Chairman Bair, how prevalent do you think your view is? I know it's out for comment right now, but what have you heard?
You know, I think there is a general sense that it is about interconnectedness. I think people define interconnectedness in a different way. And, but again, my view is not, because the financial system's so interconnected, the other financial institutions will take losses. I think we look broadly for systemic risk about the real economy, what the impact of the real economy will be. So that's my view. I'm not going to speak for others. And we'll, again, review the comments and make a decision. It will be a collaborative process. The FSOC as a group decides what's systemic and what isn't. It's not driven by any individual regulator, and I think that is as it should be.
Looking back at this crisis, at what point could this have been stopped or prevented?
I think in the early 2000s it could have been stopped with some good, strong lending standards applying across the board and applying to both banks and non-banks. I think that was the root of the problem, and there were people like Ned Graham that were pushing for that. And it didn't happen, and there were efforts in Congress, and that didn't happen either. I think one of the reasons the Congress created, and one of the reasons it didn't happen was the political pushback, and everybody was making money off of this, and borrowers too. A lot of borrowers were getting those cash out refis. They were extracting money, and there were some borrowers that were horribly taken advantage of as well. But it was very difficult as home prices kept going up to, you know, and the tremendous amount of volume that was being done and fees that were being generated to take away the punch bowl. The political will wasn't there. So that's one of the mandates of the FSOC, and hopefully collectively, we independent regulators will collectively have the will to take away the punch bowl when we need to. But I guarantee it will be a politically unpopular decision when that happens.
How often are you in contact with Ben Bernanke, and are there stovepipes in place where you can't communicate about certain things?
No, not really. No, stovepipes, no. I think we have lunch occasionally, and certainly see each other at meetings. During the Basel III process, we were seeing each other a lot, and obviously he's attending the FSOC meetings. I think it's great. I think it's very important that is a principal level body, and people come, don't delegate, that they come. So I have a lot of respect for Ben. He's been one of the heroes throughout this crisis, and I think one of the more thoughtful people that we have sitting around the table.
Tom Braithwaite.
I want to ask you about something that happens every weekend, which is that you go into banks up and down the country and close them and hopefully sell off the assets. How painful a process is this for those communities, and how far through this really difficult time are we? I think there's 130 or so banks closed in this way so far this year.
But who's counting? So that's a good question. It's never a happy thing for a bank to be closed, and but it's like foreclosures. It's a necessary thing when banks no longer become viable. To prolong it doesn't do anyone any good. A very sick bank is not going to be doing much in the way of extending new credit. And we learned during the SNL crisis that if you keep trying to prop them up and exert regulatory forbearance, it ends up costing more later on. So when they become no longer viable, it needs to happen. It's a necessary process. Almost all of our resolutions, though, are what we call whole bank with loss share. So we are able to market the failed bank to another healthier insured bank that can not only acquire the deposits and protect the deposits, but also acquire the assets too, to maintain those customer relationships. Frequently the depositors of the bank will also be a borrower. And so we try to provide continuity of the banking services that were being provided through these whole bank with loss share transactions. And I think they've worked pretty well. And a lot of community banks are being sold to other community banks, which I think is also good. I think we need diversity in our banking sector. We need a vibrant community banking sector. So I think that strategy has worked well for us and has helped mute the impact to a community.
And are we through the worst of it? Is the pace slowing?
Certainly all the indicators are that yes, we're turning the corner this year as we thought we would. Bank failures will peak this year. We had 140 last year. It'll be more, but not a whole heck of a lot more, we don't think, this year. And actually our losses will be lower. The banks that are being closed now are smaller banks than they were last year, so we think our losses will be lower. Our deposit insurance fund is also, it's still in negative territory, but it's improving. It improved by several $billion in the second quarter. So yes, banks are, we're working through those commercial real estate loans. Banks are repairing their balance sheets. And as they do that, they'll be in even a stronger position to lend into the economy. So yes, I think there are a lot of uncertainties about the economy, and but what our economists are seeing now is we think it'll continue along a sluggish recovery, but it'll continue to recover.
And just explain the state of this fund, because this is obviously what depositors are concerned about. They want to know that they're completely safe.
They're completely safe. So there is a difference between our fund balance, which is a statement of our net worth, and our cash balance, which is quite robust. That's about, I think we've got about $45 billion cash in hand. Obviously, we have substantial authority to borrow from Treasury if we ever needed to. So there's plenty of cash on hand to protect banks. The reason we have a negative fund balance is because we reserve 12 months out for projected failures. And so the accounting can get confusing, but I think for insured depositors, they need to focus on our cash balance, which is about $45 billion.
Deborah Solomon.
One of the big questions, obviously, is, you know, can this ever happen again?
Right.
We have all these rules now as part of Dodd-Frank, but you've talked about needing to just have more capital at the banks so that if there is another, you know, day of reckoning, the banks can withstand it. The banks say enough is enough. We're not lending now, and we're not going to lend anymore. You know, if you keep requiring us to have more reserves. There was recently an international agreement that would require banks to hold about 7% in reserve. Do you think that the U.S. needs to go farther than that, and how far is too far? I mean, are the banks right that this can have an impact on the overall economy if there is too much that they're required to keep on the sidelines?
No, I don't think that's right. I think, to the credit of our banks, I think we've heard that more from non-U.S. banks than we had. There were a few U.S. banks that have been making that argument too, but in the U.S., for instance, they're at 6%. Even if you deduct from common equity all the types of instruments that can no longer count as capital, their TCE ratios are still about 6%. So you're talking about another, and granted their assets are going to grow through some changes we're making in how they risk weight their assets. But over time they can deal with that problem by selling those bad assets off that are creating the higher capital charges. So going from 6% to 7% is not a lot. The Basel Accord itself gives 9 years. I don't think they need anywhere that long. You know, our estimates are within a few years of retained earnings, you know, even half the retained earnings, they can get to easily get above 7%. So I don't buy that. You know, you can retain earnings, you can decrease your bonuses. There are a lot of things you can do to conserve capital. You can sell assets. There are a lot of things you can do to build capital without cutting back on your lending. And the place is awash with cash right now. There's plenty of lending capacity, whether it's 7%, 8%, 9%. There's still going to be plenty of lending capacity. And I think really, to get that going better, I think we need two things. We need better borrower demand, and that's going to depend on more confidence in the economy and what's going to happen with the economy. I do think on the lending side, there needed to be some credit tightening of credit standards. Obviously, there were loans that should not have been made beforehand. I do worry that we've shifted too far in the other direction now. The smaller banks, their loan balances generally have stayed, for community banks, have stayed stable and actually have ticked up a little bit. But the large banks, we keep seeing decreases quarter after quarter. I'm hoping in the third quarter we'll start seeing a bump up there too. But
and so do you think they need to go higher than even the Basel Accord?
I do think for this very large institutions, for what we call the SIFIs, the systemic institutions, I think it should be higher than 7%.
Do you have a number in mind?
I don't want to, you know, it's the Federal Reserve Board's call, but I think the U.S. has been unified in our position with the international community that there needs to be a higher charge for the very large systemic entities because of the external risks they create. And so whether we'll get an agreement with the international community, I don't know. That's in the FSB bailiwick, and we're not on the FSB, but I do think we have unanimity here in the U.S. that there needs to be a higher charge for systemic entities.
Chairman Sheila Bair of the FDIC is our guest here on Newsmakers this week. Deborah Solomon of the Wall Street Journal and Tom Braithwaite of Financial Times are our guest reporters. We have time for one more question each. Mr. Braithwaite.
The Troubled Asset Relief Program, which everyone hated, and it was $700 billion and billions went to AIG. It seems like it's not going to cost very much, if anything. Does this change the philosophy now? Does this mean that people will be less likely to pursue the resolution authority you're diligently putting in place and say, well, we can get our money back if we do something a bit more on the open?
Right. Well, we don't know what the final price tag is going to be, and I think Fannie and Freddie also need to be factored into the equation in terms of the ultimate cost of government support for the financial services sector. And nobody will be happier than me if TARP, those lower loss projections come to fruition and are accurate. That would be very good news. That said, the moral hazard created by this whole process, the political disillusionment of making these massive infusions of taxpayer money into these institutions to stabilize them, have been very damaging to our financial system, to market discipline in our financial system, and to, frankly, how the popular will views the financial system and views the government and the regulatory agencies. So I will say we should never have to do this again. And, I guess I would also have to say, there are a lot of businesses, small banks and other types of businesses that could survive easily for 2 or 3 years if the government just kept backstopping them until they got on their feet again. But is that the way free markets are supposed to work? I think if we embrace that as a philosophy, as a policy, we lose a lot of our market-based system, and that's a road I just don't think we should go down.
There's a lot of anger towards the banks, and you even hear, the White House taking a lot of shots at Wall Street. Right. Do you agree with that point of view? I mean, do you think that Wall Street is to blame for this, or do you think it's helpful to have sort of this antagonistic relationship right. between Washington and the banks that, for better or worse, really do drive the financial
right,
markets?
Right. Well, no, I think antagonistic relationships are never helpful in any context. And I also think you should be careful about painting everybody with the same broad brush. There are small banks that did some really high-risk taking, not smart things. And there are larger banks that manage pretty well through this crisis. So I think painting everybody with the same brush is not helpful. I think in terms of customers of financial institutions, they really should decide for themselves whether they're being well treated or not. But if they're not, they should go down the street. And I think that's one of the reasons why it's important to have a diverse banking sector with large regional and smaller institutions, so people do have a choice. And so no, I think we need to focus on issues, not institutions or personalities. But clearly there was some, with the large institutions there was excessive risk-taking because of their size. It had a much more dramatic impact on the economy.
And finally, Chairman Bair, the courts have gotten involved in a lot of the mortgage decisions right. being made. Right. Is that frustrating for you?
No, I don't think so. I mean, I think that it's a state-driven process, and so the laws are what they should be. So, since we regulate state-chartered banks, our banks are used to complying with all these different state laws, so it's really not something we view adversely. It's I think where there's a judicial process for foreclosure, that's what banks need to follow, whether they're a national bank or a state-chartered bank. And so, again, if there's some rules that weren't followed, and it appears like there were, at least on a process, and we know that, that needs to be fully remediated before they move forward.
Sheila Bair is the chairman of the Federal Deposit Insurance Corporation. Thank you for being on Newsmakers. Sure. We'll be right back with our guest reporters. We're back with our reporters. Deborah Solomon of the Wall Street Journal, what did you hear from Chairman Bair?
I thought it was interesting, her views on which firms should be determined to be systemic. That's obviously going to have a huge impact on these firms' ability to operate, under the cloak of darkness. And she really seems to see interconnectedness as the linchpin here, whereas a lot of other folks would say asset size or how many counterparties they have. But she's looking at, and other folks in the administration seem to be looking at too, if a firm went down, where do its tentacles expand to? And that's going to be sort of the ultimate thing that determines whether a company is systemic, not whether they manage, $25 billion in assets, or if they have, counterparties in Europe and in Asia. It's really, how far do their tentacles spread into the financial sector?
But in today's world, isn't everything interconnected? And how do you write regulations that reflect that?
Well, I mean, that's a huge issue for them. And yes, there are, so many firms are interconnected. But, a hedge fund that basically has, that does a lot of swaps with a lot of participants around the country, that could have a bigger impact if all of a sudden they went down because, people would start calling their positions and they would be unable to make good on some of their positions. And so you could see a Lehman-like situation develop there. But this is going to be a hugely hard decision for them. And I can guarantee you that there's going to be a lot of lobbying from the companies that might be swept into this, to prevent such a designation from happening.
What kind of time frame do you see this being enacted on?
I believe this has to happen fairly quickly. I'm not 100% 100% sure what the date is, but the firms say they need to know, if they're going to be designated as systemic, and they did put out this request for comment. I think it's a 30-day request, and basically they're telling people get your comments in quickly because they plan to move fast.
Tom Braithwaite, what did you hear from the chairman?
I thought it was interesting. She was quite frank that there were problems in the new era of regulation, and that she wanted a more streamlined